Now, one of the things that we talked about when we were discussing Asia and more specifically China is the source of funds for developers. And it keeps coming back, and now we have a bit more data on how that has changed and who's been buying what. So there was some positive news that they were seeing some sales and things were picking up, but now the data is out on who was buying them and what was being bought. And I think that there's a lot to discuss here. So first, developer source of funds. You can see that advance payments is so important, which is why when the government kind of took away the ability to tap that escrow, tap that advanced payments, that became a big burden. Because how are you going to go out and do it? And that's where they've tried to self-raise. They've tried to take domestic loans, foreign investments. But there's only so much that can be done because all of this cash is essentially locked up and they're asking for access to it. So pre-selling dominates residential home sales. To give you an idea of a lot of this, I mean, and we've seen it here. It's not like it's abnormal to see, pre-sales, but they were taking that cash and not using it to build what they were supposed to build. Instead, as we saw with Evergrande, they were buying EV companies and soccer teams. So the idea is now hone it in and essentially put a box around it where if you take that pre-sale, you can only use it for this building. And I think that would help clean up some of these unknowns. So in the embattled developer Kaiser Group to resume construction at the project in Foshan after receiving funds held in escrow. So Kaiser has pledged to resume construction at a project in the southern city after funds held in escrow accounts were returned to it. It follows reports that China is drafting rules to make it easier for developers to access funds from sales still held in escrow accounts, which is fine, and I think it's important that we try to get this moving through and we continue to adjust this, but within a context. It all has to be in a box where it can only be used for this building or for this, let's just say project that is wholly the building, not going out and buying, a battery farm. Like, these are those key pieces. Now, some of the things that have also been done, more easing in China, some developed provinces intended to reduce the spread of local bonds to 10 basis points from 15. That is, the lower limit of the local coupon rate range will be 10 bips on the basis of the government bond base rate. Depending on the bidding, which is, again, and then what happened afterwards, the PBOC also injected 150 billion yuan, a 14-day reverse repo, also cutting the rate by 10 basis points to 2.25% from 2.35%. Preparation for the Chinese New Year holiday. So we always get an increase in liquidity ahead of the Lunar New Year, and that's not going to change at all. But we also saw some sales going through, and there was some hope that things were loosening up on the front of the private sector, the public sector. But what does this mean? I should say the property sector. But who's buying what? So local governments to the rescue. So how good is it that the local governments are using the LGFVs that the PBOC and the CCP have been trying to slow down the purchase of? So in 9 of 21 large Chinese cities that packed in land sales over the last 2 months of 2021, at least half of the plots were bought by so-called, the LGFVs. Some of these purchases were worth billions of dollars. While the moves may help arrest a land sale slump and provide much needed revenue for local governments, the purchases threaten to exacerbate risks for LGFVs, the second biggest non-financial borrowers in the offshore market and the biggest onshore. Purchasing land will usually lead LGFVs to pile up borrowings and increase leverage. It's not easy for them to pare them down afterwards. So again, this is why there's so much concern about, okay, well, they stepped in, but at what risk? And that's why there's the good side where land sales move through, some things are loosening up, but at what point? Is there too much pressure? Is there too much of a good thing coming through? So on the surface, the recent land auction by the Chinese city of Rizhao appeared routine. There were 4 bids pushing the price up 11% to 170 million. But a closer look reveals something interesting. The offers were reportedly made by a finance entity owned by the Rizal government, meaning the city effectively sold land to itself. Across China, local government financing vehicles, the LGFVs, have replaced cash-strapped property developers as the biggest buyers of land for real estate development, stoking fresh concerns over the ability of these off-balance sheet borrowers to repay a debt pile that tops $8.4 trillion US by some estimates. I know people say, oh, it's fine, they'll figure it out. It's like there's a lot of off-balance sheet debt, and it's only getting worse, all for window dressing into year end. Now, the Chinese one-year prime loan rate down 10 basis points to 3.7%, but you can see it never went up from 2020. So, and then when you look at the China one-year prime loan rate, instead of being at 4.6%, it came in 5 basis points. So you're continuing. This is the liquidity trying to push some through ahead of Lunar New Year, also providing some of that support to stop the decline in rates. In credit impulses. But let's look at the liquidity side. So liquidity is pointing to stabilization, but not a surge in the credit impulse. And this is the chart. I've been describing this and I apologize for those that watch these every week because you've probably gotten disgusted at me saying it. But this is what we're seeing. This is the exact thing. The excess reserve ratio flatlining, credit impulses kind of bouncing right here, but it's not going much further. It's really just kind of just pausing, which is something that I think is important to appreciate when you look at what is the PBOC trying to achieve. So now when we look at the lead lag relationship between share prices and money credit cycles, you get an idea of that stock prices are still elevated, even though the question is, does it bottom? Impulses have started to bottom, but as you start to see rate rises, you start to see pressure as we're seeing from after a reversal again in the U.S. indices. There's a lot of this unknown, and that's why I think that there's an avoidance, especially as more debt gets layered on, especially off-balance sheet debt, because what is that underlying exposure, and really what are you getting involved in if you start to invest in some of these entities? Infrastructure spending primed for an increase, but by how much? Because government expenditures are flatlined, infrastructure investment also flatlined, but we're not seeing this huge surge again, which is why we do expect it to move sideways and not see this huge expenditure, especially from the government that is already hamstrung, and we're seeing them try to do something on the property side, but how much is actually available to keep that going? So the macro policy austerity poised for the reversal, which is what we've been talking about. You're starting to get some of this reversal here, but look at what happened in that 17, and then you had that shift in 18. There's not a huge amount of tightening that happened in 19 and 20. In 20, you had a huge shift down. You had a lot of movements, but look at what policy austerity is. So how long has the austerity been? It's been fairly deep, but do they really want to go back into expansion? Do they really want to ease given the underlying problems that we continue to highlight and see? And that's where it's more about a lessening. It'll get a little bit of a thrust, but you'll still have that social financing under zero. Now, when you look at the China industrial profits, we'll post a single-digit contraction, and this just gives you an idea of where that movement comes down as the industrial profit comes lower, which again flies to what we've been talking about with some of the pressure on the equities, on some of the valuations as they shift down. Now, the developer financing flows continue to deteriorate as we go through, which is what they're trying to arrest. Now, coming full circle to this, because you look at self-fund raised funds, total loans. So China is drafting nationwide rules to make it easier for property developers to access the funds. Chinese developers are allowed to sell residential projects before completing them, but are required to put those funds in escrow accounts. The cash held in escrow typically accounts for 50 to 70% of developers' pre-sale funds, without giving an estimate. So that's why they're trying to unlock it, because they're not getting loans. Nobody's giving them loans. You can't self-fundraise at this point. You're seeing the governments, and especially local governments, do it between themselves. So what is going to arrest this slowdown? And that's why they're trying to restructure this. And we've already seen some of that money not going to where it's supposed to, even though it's already supposed to be held for that project. We know it's been siphoned off into some of the other areas. So now when we look at China export and the MSCI index, here's where you have exports continuing to come down, continuing to slow as we broke it down between Chinese imports and exports. And that's where that movement down on earnings, and again, coming back to, there's more than just the credit cycle that's going to support, that needs to be supporting valuations, and which is why we see some more downside and pressure in terms of where some of the Chinese stocks will go. Now, the largest Chinese property defaults, just to give you an idea, is still Evergrande, and there's more to come, which is why we still remain cautious on what is happening here. And now with LGFVs increasing off balance sheet debt, how much exposure is at the government level, especially the local government, local provincial level, that will put more headwinds into the situation. So looking at the credit impulse in a different way, looking at against global manufacturing PMI, even with a bounce or a sideways move, there's still a lot of room for the global manufacturing PMI to come down. And this is where we continue to see some of the pressure on a global front as we broke it down in segment 1. So then when we turn and look at new home sales, they're expected to drop 6 to 9% in 2022. Again, more pressure in terms of where the economy is going to be as we have multiple slowdowns heading into this year. Now, shifting a bit to other nations, now that we've looked at China, it's good to look at Vietnamese exports. So you can see exports on an annual level continue to grow, growing into the U.S., slowing into China, some of these other areas. But when you think back to the industrial production chart we had in segment 1, you can see industrial production has been sideways for a decade. But yet we're importing more exports from Vietnam because industrial production isn't increasing on a net level. It's being shifted from one to the other. And again, some of these ASEAN nations, the shift away from China, or at least diversifying away from China, because you're not, again, closing at anything. You're just building something new, or you're closing one thing in China to increase it in Vietnam, or you're decreasing the utilization rate of what you're taking from China, increasing it from Vietnam or some other nation, and trying to, again, protect and diversify your supply chain. But when you look at growth in South Korean and Taiwanese exports, it's weakened a bit as you've seen that slowing global manufacturing conditions. So it's still expansionary, it's still growing, but you can see that the pressure is coming along. It's still high, there's still good numbers, but there's downward moves that are in the works, which is why we remain concerned on a global standing, if you will, when we're looking at what is happening in the on the trade front. So then when we look at South Korea, again, coming to exports, so the 20 days, last month was exports were 20%, came in at 22%. Imports 20 days coming in for January. Expectation last month was 42.1, came in at 38.4. So again, still there. It's not. It's just it's a slow. You were seeing some pressure going forward on what the future is going to be for some of these. Still going to be good. Still going to be a net positive. Just not as good as it has been, but also comps get a bit harder. So nothing crazy there. Now, Thailand, custom exports estimate was for 16.4%, came in at 24.2%. Custom imports were expected at 18.15%, came in at 33.4%, which, as we all know, is a great indicator of strong exports coming forward, which is what we expect to see out of Thailand as well, with exports continuing to be a big driver. Now, when we look at Japan, when you look at CPI, came in just below estimates, was expected at 0.9, came in at 0.8. But then when you look at PMI, so not surprising given what we were talking about as we got into January, PMI services came in at 46.6. PMI composite came at 48.8. PMI manufacturing came in at 54.6. So manufacturing was still strong, still what we've been talking about, where the export side, the manufacturing side is still strong. It's the local consumption that is weakening. And this is the perfect example of it in Japan, where manufacturing is there, but the composite is in contraction again. Services is in contraction again. And those are some of those headwinds that we've been highlighting on the local front, which again is not Japan. It's not just Japan. It's not just China. It's a global level, but especially in Asia. So then when we look at the Japan composite, showed a renewed downturn in private sector activity in January with the flash composite coming in at 48.8. Price pressures showed signs of easing though, which is a positive when you're thinking about trying to incentivize not only additional exports, but local consumption. So then when you look at flash composite against Australia, something similar. You had a steep negative number, same with Japan. Again, just showing some of that pressure that is in Asia that is yet to really, I think, be felt by the market in general. Manufacturing and services. So Japan manufacturing output staying fairly flat, but Australia manufacturing services, Japan services all coming down, all I think being a little bit of that overhang that we've really been alluding to. So then when you look at input and output price indices, you can see that in Australian Australia input prices, Australia output prices, starting to go sideways just with Japan, but they're sideways moves. They're not down moves. They're just kind of going sideways a bit and working sideways, keeping that inflation, keeping that stagflation. And Japan is a huge exporter, which just means that it's going to continue to be exported into the market as it is with the others. So that's what we have for you today. If you have any questions, you can find us on the comment section or in obviously on Twitter. We appreciate any questions you may have. And please, again, like, share, subscribe. We appreciate your support. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.